Friends, welcome back to our channel OMSAI Bhojanapalli.
Good morning, friends. We are doing the chapter bond valuation, in which last class we completed one sum relating to forward rates calculation. Just one or two issues to be discussed, and then we can have a notes regarding the forward rates. One more problem in forward rates we will be doing today, that is question number 18. That is how to calculate forward rates when you have zero rates. We will be discussing question number 18. Once that problem is completed, we will do a small area called as bond refunding decisions, or also they call as callable bonds. Number 2, we discuss about value analysis, one small concept, and then discuss about convertible bonds. Next class, we'll discuss bond convexity and the duration and volatility derivation on that particular aspect, something called as Malkiel's theorem, which shows the features of the bond mathematically. All those we'll be discussing in the next class, and completing the chapter bond evaluation, and then start with the next area called as dividend policy, from where we start discussing about equity shares. Dividend policy, portfolio management and equity valuation, you have a separate chapter. All the three predominantly focus on the equity share aspect of the syllabus. Then we'll go to leasing and other concepts. So now let us summarize what is done in the bond before I proceed further. Able to hear me clearly? Yeah? Audible or not? Okay. First of all, we saw that companies requires funds to invest in the assets, and the asset will be generating the return. The fund providers can be classified into two categories, equity and then debt. Equity expects a variable return for the money given. Debt expects a fixed return for the money given. So the debt instruments are also called as fixed income securities. So here the debts we normally call as bonds here. There are so many other varieties of debts also. Bonds are market traded securities. Above the bonds we discuss certain features. Number 1, bonds are classified into 4 types, namely a plain bond, annuity bond, perpetual bond, zero coupon bond. Plain bond gives coupons for n year and redeems in nth year. Annuity bond pays installments every year that covers coupon as well as the principal portion. Perpetual bond pays only coupon but has got no redemption. Zero coupon bond has no coupon but only the redemption or maturity value. For all the 4 types of bonds, we discuss how to calculate value, yield to maturity, duration and volatility. Value of a bond, we said value of a bond is the present value of the future cash flows from the bond. So in case of the plain bond, it will be future coupons and maturity. Annuity bond, it is future installments. Perpetuity, it is perpetual coupons. Zero coupon bond, it is maturity value. When we calculate present value discounted at required rate of return, will be giving you the value of the bond. The required rate of return represents the risk of the bond. More risky the bond is, higher return the market expects from that particular bond. Next, the yield to maturity of a bond is the yield a bondholder earns provided he holds the bond till maturity. That importance I said in the last class. So what is YTM? Yield the bondholder earns from the bond provided he holds the bonds till maturity. This YTM can be calculated for a plain bond in 3 ways. Formula 1, interest after tax plus amortization divided by average price. Formula 2, interest after tax plus amortization divided by weighted average price, which is 0.6 into S plus 0.4 into M. or it is IRR of the bond cash flows. And in case of annuity bond, the only way to calculate is IRR, where we have discounted cash flow is equal to cash flow into annuity factor. Discounted cash flow is the bond price, cash flow is the annuities we are going to get, and find out the annuity factor. Search the annuity factor against years to find out the interest rate. In case of perpetual bond, yield to maturity is the coupon divided by bond price. In case of zero coupon bond, yield to maturity is once again IRR, where we use the formula future value is equal to present value into 1 plus R power n to calculate the IRR. Duration of the bond is the average period for which the money is blocked inside the bond. But a better way to understand is it is the optimum bond holding period, or 3 is it is the calculation for volatility. Duration for a plain bond can be calculated in two ways, table approach as well as formula. Table approach it is write the cash flows, discount it using YTM, find out the discounted cash flow, find the discounted cash flow to the bond price, the proportion, multiply the proportion by years, you will be getting the duration. Or the formula for duration is 1 plus y by y minus 1 plus y plus t into c minus y divided by c into 1 plus y power t minus 1 plus y. In case of annuity bond also same two methods, but the formula changes to 1 plus y by y minus t by 1 plus y power t minus 1 plus y. In case of zero coupon bond, the duration is 1 plus y by y. Sorry, in case of perpetual bond, the duration is 1 plus y by y. In case of zero coupon bond, the duration is the maturity of the bond itself. Volatility is equal to duration by 1 plus y, where the volatility of 3% means when the bond price changes, when the yield to changes by 1%, the bond price approximately inversely changes by 3%. These are all the issues we discuss about the four types of bonds. Then we discuss about realized yield to maturity. Yield is what the bond gives its bondholder. Realized yield is what the bondholder ultimately earns. What he ultimately earns not only depends on what the bond gives, it all depends on what he does with the money given by the bonds. It all depends on his reinvestment rate. When the reinvestment rate is more than the yield to maturity, his realized yield will be more than yield to maturity. When reinvestment rate is equal to yield to maturity, realized yield is equal to YTM. If the reinvestment rate is less, realized yield is equal to less than YTM. Sorry, in that case, we saw that the realized YTM not only depends on the bond performance, also depends on his ability to reinvest. In that case, reinvestment rate affects the bondholder's yield or not. So how to immunize himself against the change in realized YTM? He has to go for the immunization strategy, where you identify how many years you want to be in the market. Don't search for the bond with the life of your time horizon. Search for the bond with the duration of a time horizon. If you hold it till duration, the realized yield stands protected. Is what you have seen in the immunization strategy. Because when the general interest rate increases, I am happy because my reinvestment income increases. I am unhappy because my bond price decreases. If the interest rate decreases, I am unhappy because the reinvestment income decreases. Happy because the bond price increases. The capital gain or loss will exactly offset the reinvestment income or that is non-receipt of reinvestment income. In that case, if I hold till the duration, this is what has been discussed in the immunization strategy. I think next we discuss about this particular concept called as forward rates. Let me summarize and then go to the next stage. See, we understood forward rate with the help of question number 17. See, we saw in that problem, there are three bonds. A 1 year bond, a 2 years bond, and then a 3 year bond. The common thing is all the three bonds are not of different entities. They belong to the same issuer, that is namely the Government of India bonds. Now, these three bonds we calculated the yield to maturity, right or not? We calculated YTM of a 1-year bond, YTM of a 2-year bond, and YTM of a 3-year bond. This we calculated in the previous class. If you remember, right or not? No. This is what we calculated as yield to maturity of the bond. 1-year government bond is trading in the market at how much percent? 9.29%. Your 2-year bond is trading at how much percent? 10.87. A 3-year bond at how much? 10.91. It is an interesting thing because same institution bond should be trading at the same yield to maturity. For example, a Reliance bond and a government bond may have a different yield to maturity, but two Reliance bonds should be having what? The same YTM only. Why the YTM differs? Was the first question he asked. The answer given is it differs because they are all the bonds with different maturities. Okay, so always you have seen in banks also that interest rate offered changes for the period of deposits. Same way here also it is changing. This data only we call it as term structure of bonds. We call it as what? Term structure of bonds. Why should we know the term structure of bonds? Because with the help of the term structure of bonds, I'll be able to calculate a number called as forward rates. Why we require forward rates? Very simple. I'll discuss in today's class in another say, few minutes. But forward rates can be calculated using the term structure. What do you mean by a forward rate? The first question is, what is the yield a 1-year bond? What the market expects, how much yield for a 1-year bond? 9.29%. Always market expectation can be seen only through market price. So no, I cannot go to everybody and say investigate or interview for this bond how much you want. We cannot interview. We can only see through what? Market prices. Because we see 91,500 the bond is trading, redeemed at what? 1 lakh means immediately we can know that the market is expecting how much yield? 9.29% yield. Always market shows its feelings only through what? Market price. Okay, shareholder don't speak through words, they always speak through what? Mouse only by just clicking up and down buy or sell orders. So market price only shows their heart. So 1-year bond market is expecting how much yield? 9.29. Tell me 2-year bond it is expecting how much yield? 10.87 per annum. Now the question is, what is the yield expected in second year? Everybody yes or no? No, we cannot say that 2-year bond yield is 10.87. So they expect 10.87 in first year, 10.87 in second year. That is wrong to say because we know that they are expecting what? 9.29 for the first year, because this is not for some other different bond. It is for what? Same government bond only. We can know that they expect 9.29% for what? First year, and on an average they expect what? 10.87% per annum for 2 years. We should know what is their second year expectation. That is what we call it as what? Forward rates. How to calculate forward rates for the second year? Using 1-year bond or 2 years bond or 2 years bond. We just calculated as follows, just to summarize it. Tell me value of a bond. What is the value of a 2-year bond? 98,500. The cash flows are first year coupon 10,000, second year coupon redemption 1,10,000. This 10,000 is received in first year or second year? First year. Discount using the first year expectation 9.29%. This 1,10,000 is got in what? Second year. Discount using the second year rate R2. It is brought to what? First year. Discount at first year rate 9.29. Bring it to year 0. That should be equal to 98,500. If I rearrange it, I will be getting R2 as how much percent? 12.65%. In other words, the investors are expecting first year how much? 9.29%. Second year 12.65%. On an average for 2 years 10.87% per annum. Respond. Are you all following or not? No. Similarly, we found out for a 3-year bond. 3-year bond gives you 10,500 first year coupon, 10,500 second year coupon, 1,10,500 third year coupon and redemption. This 10,500 got in which year? First year. So discounted at 9.29. This 10,500 got in which year? Second year. So discounted 12.65% to bring it to first year. Again discounted 9.29 to bring it to year 0. 1,10,500 got at the end of the third year. Discounted R3 to bring it to second year. Discounted 12.65% to bring it to first year. Discounted 9.29 to bring it to year 0. All this present value should equal the value of the bond. If I find out the value of the bond, if I find out the R3, I get as 11%. Everybody, are you following out? So now can you tell me, market is expecting how much as a yield for the first year? Just a minute. How much yield for the first year it is? 9.29%. How much is the yield for second year? 12.65%. How much the yield for the third year? 11%. This is what we call as the yield to, that is the forward rates, which is based on the yield to maturity calculation. I think up to this last class we completed as well as what? Copied. Everybody respond, yes or no? One or two small issues we'll discuss and then go for the next system. Now the question is, why should we know forward rates? What are the use of the forward rate calculation? Why at all? We should know this particular number 12.65 or 11%. Forward rates are used in two places. One is in bond futures pricing. In what pricing? Bond futures pricing. And number two, in swap valuation. In these two areas, forward rates are used. One is in bond futures pricing and is in swap valuation. In the just concluded examination also, first question in the exam question paper is using the forward rates. They ask you to value the bond instruments. I think you should have seen the first question, 1A is a 5 marks question where they use the forward rates to value the bond. So that it is used for valuing the bond futures as well as the swap valuation. I'll give an example. Now, I want to issue a 1-year bond now. I want to issue a 1-year bond today. Tell me the bond cash flow should be priced at what yield to maturity? 9.29. Isn't it correct? Respond. Everybody, good morning, friends. Good morning, now we are starting summary and all over. Can I start or not? Now, see, I want to issue a 1-year bond. I want to issue what? 1-year bond. When? Today. That means what the value of a bond? Present value of the future cash flows. Now, the future cash flow discounted what percent? 9.29. Because 1-year bond will be priced today at an yield of how much percent? 9.29%. Respond yes or no? Now, next. I want to issue a 1-year bond. I want to issue a 1-year bond, but not now, after 1 year. Are you following? Issue now. I want to issue a 1-year bond, not now, but after 1 year. But I want to freeze the price now itself. Are you following not? How we can do for foreign exchange? Na? In a forex, we have a forward rate or not? No. I want to buy a dollar after 1 year, but I want exchange rate today. We arrive at an exchange using IRPT, right or not? Like that. I want to issue, suppose I am a company, I want to issue a 1-year bond. I am a trader, I want to buy a 1-year bond. 1-year bond is going to be issued not today, after what? 1 year. That 1-year bond that is going to be issued after 1 year should be priced at 9.29% yield. Because 9.29% is the this year's yield, yes or no? But that 1-year yield will be which yield? Second year yield is priced at 12.65%. Respond yes or no? Very simple. If I want to issue today a 2 years bond, the bond will be issued at a yield to maturity of 10.87. If I want to issue a 1-year bond today, I'll issue the bond at a yield of how much percent? 9.29. But I want to issue a 1-year bond not today, but after what? 1 year. I'll issue at what yield here? At a yield of 12.65 because it is not the first year, it is what? A second year yield. For a bond futures pricing, I have to use what? A forward rate. Point number 1. Accept that. Please tell me yes or no? No. This is one way. Another is swap valuation. Another is called as swap valuation. I will discuss that later. In swap valuation, I'll be discussing something called as a forward rate method, forward rate agreement method, where to value the swap, this number will be very much used. Okay, I cannot explain that now, but I say that forward rates are used for the swap valuation also. These are the two uses for which forward rates are calculated. Examination, the forward rate itself is asked as what? Independent question for around 6 marks or 7 marks. Last examination, they use the forward rates for asking you to value a bond instrument that is asked for 5 marks in the first question part. Everybody following or not? With this we complete the forward rate, and the last thing is there's something called as yield curve we have. Okay. This is what we call as what? Yield curve. For example, A 1-year bond, if you are seeing the point, is trading at 9.29. A 2-year Government of India bond is trading at 10.87. A 3-year bond is trading at 10.91. Now, this yield is sloping upwards. Is sloping upwards or not? The rate at which it slopes upwards is what we call as the forward rate. Forward is nothing but the slope of the yield curve. We have slope of a straight line. Y is equal to mx plus c. Right or not? So that slope we call as variable cost in cost function and say respectively. Like that, this curve should be having a slope or not. The slope of the yield curve only we normally call it as forward rates. With this we complete a small discussion regarding this concept called as forward rates. One more sum is pending. Before let's have a small notes in this regard and then proceed further. Write down next. Summary. I think if I am right, you should copy it up to 11%. Write down summary. Summary. Point number 1. Point number 1. All the three bonds belongs to the same institution. All the three bonds belongs to the same institution. All the three bonds belongs to the same institution. That is government securities. In this problem it is government securities. That is government securities. Still, they trade at different YTMs. Still, they trade at different YTMs. Still, they trade at different yield to maturities. Still, they trade at different YTMs. Why? Question mark. Why? Question mark. Write down. The three bonds have different yields because the three bonds have different yields because the three bonds have different yields because they have different maturities. The three bonds have different yields because they have different maturities. They have different maturities. The change in yield is to accommodate the risk due to the time factor. The change in yield is to accommodate the risk due to the time factor. Is to accommodate the risk due to time factor. The above data is referred to as, same point to continue, the above data is referred to as term structure of bonds. The above data is referred to as term structure of bonds. Point number 1 or 2? 2. This term structure is very helpful. This term structure is very helpful in understanding. This term structure is very helpful in understanding the market expectations. This term structure is very helpful in understanding the market expectations about. This term structure is very helpful in understanding the market expectations about the future interest rates. This term structure is very helpful in understanding the market expectations about the future interest rate. Is very helpful in understanding the market expectations about the future interest rate. Because 9.29% is today's interest rate which market shows. They say 2 years bond is trading at 10.87. From that we all can understand that market expects the interest rate to be how much percent? 12.65 at the end of the first year. That is why they are asking 10.87 per annum for what? 2-year bond. Yes or no? So how the market perceives the interest rate after 1 year can be understood through what? The term structure of the bond. You will understand this particular sentence or not? So you have to understand about the market in the expression about the future interest rates. Can I proceed? Next. Point number 3. What bar? What are you saying? Can I proceed? Now, point number 1 or 2 or 3? Okay, point number 3, please. I don't understand. Continue further. Point number 3. A 1-year bond. A 1-year bond is trading at. A 1-year bond is trading at an yield of. A 1-year bond is trading at an yield of 9.29%. A 1-year bond is trading at an yield of 9.29% and a 2-year bond is trading at a 2-year bond is trading at an average yield of how much percent? 10.87% per annum. A 2-year bond is trading at an average yield of 10.87% per annum. Then what is the yield of? Tell me what is the yield of what? Second year. Then what is the yield of second year? Question mark. Then what is the yield of second year? Question mark. Write down the answer. It is calculated as, that I don't need to tell you once again, no. It is calculated as how much percent? 12.65%. Then it is calculated as 12.65%. This is referred to as, tell me the name. This is referred to as forward rates. This is referred to as forward rates. Can I proceed upon? Next. Point number 2 or 3? Point number 4. Point number 4. These forward rates are nothing but the slope of the yield curve. These forward rates are nothing but the slope of the yield curve and represents the market expectations about the future yields. Full stop. If you want, just draw the yield curve. Don't draw so elaborately. Just one x-axis, y-axis. Draw like this a curve. That is called as what? Yield curve. 1 year. You want me to show how to draw it, huh? Okay, because then we'll take 1 hour to draw this, putting all the Excel lines. Okay, very simple. Draw a line like this. This is x-axis. This is y-axis. Here. I'll draw along with me or not. This is number of years. And this is the percentage. Okay. Simply draw like this. 1 point. Wait here. 1 year. 2 years. Okay. 3 years. That's all. Yield curve over. Finish copying or not? Please copy quickly. in a clumsy diagram, I don't want to show too long in the slide. Can I proceed? No. Finish copying or not? Don't copy exactly. Don't draw, strike it off, put all this over in line. Can I proceed? No. Next, 0.3 or 0.4 or 0.5. 0.5. Why should we calculate forward rates? 0.5. Why should we calculate forward rates? Why should we calculate forward rates? The previous I said we don't have any work, we calculated. Okay, so why should we calculate forward rates? Branch it into two. Branch it into two. First branch, for bond futures pricing. First branch, for bond futures pricing. For bond futures pricing. Second branch, for swap valuation. For bond futures pricing, for swap valuation. Bond futures pricing, put that down and I can write. If we want to issue a 1-year bond, if we want to issue a 1-year bond now, we will price the bond at an yield of, if we want to issue a 1-year bond now, we will price the bond at an yield of, how much percent? 9.29%. If we want to issue a 1-year bond now, we will price the bond at an yield of 9.29%. But if we want to find a price of, the price of a 1-year bond to be issued after 1 year, but if we want to find the price of a 1-year bond issued after 1 year, but if we want to find the price of a 1-year bond to be issued after 1 year, we should discount at what yield? Second year yield. We should discount at second year yield at how much percent? 12.65%. We should discount at second year yield at 12.65%. At 12.65%. Comfortable or not? No. Second branch, swap valuation, discuss later. I cannot tell you, we have to explain what is a swap, how it works. We'll discuss it later. Separate chapter, 2 chapters here for swaps. One for interest rate swap, another for currency swaps. We'll be discussing it later. Everybody, are you comfortable or not with this? We have completed this small concept called as forward rates. Let's do one more problem in the forward rate and then go for the other concepts. Who is asking question here? Super.
Why can't we tell 2 times the first year's YTM minus the second year?
1 minute, yeah. Look at the diagram. Straight line a curve. We cannot do interpolation. Understood or not? See, it is 1 by 1 plus r power n. We are having na, so we cannot do the interpolation at all. Okay. If it is a straight line, what you can say is what? Right. Because any 2 points, I can say 2 times 10.87 minus 1 time 9.29. We'll be getting the answer. Since the curve, the distance always cannot be same. You should use only the discounting technique to find it out. Understood? Now, take the next sum. Please. Class not over. Now only started. Shall I proceed? Now. Tests are there. Take question number 18. Okay. This is a different sum. Even though we are going to calculate forward rates, the sum is a different sum where we can use much more simpler method. How he said no, we'll be using that method for this particular problem. We'll see what is so unique of this problem while doing the solution. Take question number 18. Settle down, don't talk. Following is the yield structure of a AAA rated debentures. Always understand one thing, companies going for the public issue should get their securities rated, right or not? Even equity share should be rated. I think you know it or not. Not only bonds here, any company raising money from the public should get themselves rated from a credible credit agency, as a rating agencies, by showing all their financials and their future prospect, and based on the rating only, the yield is generally perceived by the public. This bond is what bond? AAA rated debentures. A 3-month bond is trading at 8.5% yield to maturity, 6 months bond 9.25%, 1 year bond 10.5%, 2 years bond 11.25%, 3 years and above it is 12%. This is the detail given. Can we start or not? Now, tell me. All these percentage given are coupons, YTMs. All the numbers given are what? YTMs. Okay. Now, the problem is a little bit different from the previous sum. In this sum, they are given you what? Coupons. They are given you what? Coupons. From coupon, one can find out what? YTM. There is nothing great about it. Then we found out YTM and did the problem. Right or not? So, all the numbers given here are what? Coupons. But in this sum, they did not give you coupon. They gave you what? YTM. We don't have the coupon data here. Right or not? Now, from this, if the data given like this, we should first assume that these bonds are zero coupon bonds. This is what bonds here? Zero coupon bonds. Because I know the YTM, you cannot tell me what is the coupon for this bond. Right or not? In that case, we assume if a data is given like this, we have to assume that the data given is what bond? Zero coupon bond. The YTMs of the zero coupon bond are very popularly called all over the world as zero rates. Because what rates? Zero rates. Zero rates means nothing rate is the yield to maturity of a zero coupon bond. We will be calling it as zero rates. Everybody, are you following or not? Now, so we assume that all these rates are what rates? Zero rates, or they are all YTM of the zero coupon bond. So, zero coupon bond has a price today and also has a maturity. That's all. In between, no coupons are given. Okay. Now, here I make some assumption and do some calculations and then make the forward rate calculation very simple. Just don't question my assumption. We'll know that why it is made at the end. Can I start doing the solution or not? Now, let me start with the discussion of the solution to this problem. Carefully follow. Once the stage is completed, I'll give you time to copy it. Okay. I think I did not read the full question now. The question continues. Based on expectation theory, calculate the implicit 1 year forward rate in year 2 and year 3. That means ask you to calculate the second year rate and then third year rate. And if the interest rate increases by 50 basis points, what will be the percentage change in the price of the bond having a maturity of 5 years? Assume that the bond is fairly priced at the moment at rupees 1000. All this will be discussing it later. So now, can we start with the solution to this problem or not? Now. See, 3 months, 6 months, I ignore it because a question asked about what? 1 year forward rate in the second year and then what? Third year. That means I want the data only for 1 year, 2 year and 3 years bond. Can I start or not? Now, see, I am going to assume that all these bonds are zero coupon bonds. Or what bonds? Zero coupon bonds, which a maturity value of, it is OF. The maturity value how much rupees? 1000. That's an assumption. Okay. It doesn't matter even if I assume as 10,000 or 100. Just for you to understand, I make this particular assumption. So all the bonds which are given in the question is assumed to be coupon paying bonds or zero coupon bond, zero coupon bonds. What is the maturity value, the future cash flow of this bond? 1000 rupees. Can you start or not? Now, tell me, what is the value of a bond today? The present value of the maturity value discounted at the given yield to maturity. Respond, yes or no? What is the value of a bond? First class, what is the value of the bond? Present value of the future cash flows. In zero coupon bond, future cash flows or future cash flow? Future cash flow. What is future cash flow? 1000 rupees. Present value of the maturity value gives you the value of the zero coupon bond. Respond, accept or not? Let's start doing the valuation. I want to value 3 bonds. A 1 year zero coupon bond, a 2 year zero coupon bond, a 3 year zero coupon bond. I want to do the valuation. Everybody following what I am saying? Now, let us value the 1 year, 2 year and 3 year zero coupon bond. And then from that, let us start our discussion regarding the forward rates. Can I start? Now, I'll do it in the slide. Before that, I'll do manually and then do it in the slide. Please help me out with the calculation. Now, I have to value how many bonds? 3 bonds. Okay. Tell me the question number. 18. Okay, 18. See, I am going to value what? 1 year, zero coupon bond. Year, cash flow, present value factor at. A 1 year zero coupon bond is trading at an yield to maturity how much percent? 10.5% and then discounted cash flow. Ennappa, right or not? Now, tell me, I am going to get money after what? 1 year. What the maturity value? 1000. So take the calculator. 1 divided by 1.105 is equal to, I want a number here, 4 decimals. 0.905. Okay, 0.9050. So it is 1000 into 0.9050 gives how much? 9050 rupees. Sorry, 905 rupees. Okay, next. Good morning. Yeah, sorry. Okay, here. Plus cash flow, present value factor at. Now, 2 year bond will be having an yield of how much percentage here? 11.25. Okay. And then discounted cash flow. I am going to get after how many years? 2 years. How many rupees? 1000. Tell me, 1 divided by 1.1125 is equal to how many times here? 2 times. Tell me, what is the value? 1% point? 0.8? 0.80? 80. It gives how much rupees here? 808 rupees. Now, here, cash flow, present value factor at how much percentage? 12%. And then discounted cash flow. Tell me, a 3 year zero coupon bond mature how much rupees? 1000. 1 divided by 1.12 is equal to 3 times. What's the number? 0.7? 0.7118. 711.80 is the price at which the 3 year zero coupon bond is trading. Everybody, are you following or not? Like this, one can find out the price of the bond today by using the respective yield to maturity as one discount rate. You have to understand, very simple. Market expects that they want a return of how much percent? 10.5% of 1 year bond. They'll get the return only if they buy the bond at how much of base? 905. 2 year bond, the market wants how much return? 11.25, which they can earn only if they buy the bond today at 808. And 3 years bond, they want how much return? 12%. So the yield is for only how much return? 711.8. Like that, one can calculate the price of the bond today for a 1 year, 2 year and 3 years bond, assuming the maturity value to be how much rupees? 1000 rupees. Please respond. Are you following up? Now, look at this. Price of 3 zero bonds. Zero bonds are nothing but zero coupon bonds, popularly called as zero bonds. Bond computation value. 1 year bond, 1000, discounted at how much percent? 10.5%. How many years? 1 year. I'll get the value as 904.98. You round it off to 905. Not an issue. 2-year bond, I discounted how much percent? 11.25% for 2 years. I get the value as 807.98. I think you call us 808. Okay, not an issue. 3-year bond, I discounted at 12%, 3 years. The value is 711.78. This is the value of a 1 year, 2 year, and then 3 year zero coupon bonds. Up to this, everybody following up? Now, let's copy up to this before we go for the next stage of discussion. Give question number 18. Question number 18. Write down. Let us assume all the bonds given. Let us assume all the bonds given to be. Let us assume all the bonds given to be. All the bonds given to be what? Zero coupon bonds. Let us assume all the bonds given to be zero coupon bonds. And the YTMs of zero coupon bonds are called as, and YTMs of the zero coupon bonds are called as, and the YTM zero coupon bonds are called as what? Zero rates. And the YTM of zero coupon bonds are called as zero rates. And YTM of the zero coupon bonds are called as zero rates. Let us further assume that these bonds have maturity value of, let us further assume that these bonds have maturity value of, how much rupees? 1000. Let us further assume that these bonds have maturity value of 1000. These bonds have maturity value of 1000. Their current market prices are calculated as follows. 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 Copy this particular slide quickly. So 1000 into, how to understand present value factor for what percent? 10.5%, 1 year. Next is 1000 into present value factor for 11.25% for 2 years, and so on. Copy the slide quickly. Finish copying up. Please stop talking. Those who are not copied, raise your hand. Shall I proceed? Now, see, we have to calculate now forward rate. We have to calculate the forward rate. Answer my question. What is the yield to maturity of a 1 year bond? Tell me. 10.5%. What is the yield to maturity of a 2 year bond? 11.25% per year. Okay. In that case, first year yield 11.25, second year yield 11.25, true or false? No. First year yield is what? 10.5. Second year yield is something higher. On an average, become how much percent? 11.25. So we all know that 11.25 is not the second year yield. It is what? 2 years yield per annum. Respond. Are you following what I am saying? So now if I am asked to find out the second year yield, that is what we call as what? Forward rates. Enna parayda? Now, we have to calculate a forward rate for second year using a 2 year bond. Last problem is on not. We have to calculate forward rate for the third year using what? A 3 year bond. Respond yes or no? No. So let us see the forward rate calculation in the way similar to what I did in the previous sum. That method can be applied, but in this case it can be further simplified. Is what I am going to discuss now. Can I start or not? Now let me start with the discussion. Okay. See. I am now going to calculate forward rate for which year? Year 2. Okay. Now, we all know that the 2 year zero coupon bond is having a price today. How much rupees? 807.98. Yes or no? Now, what is the price of a bond? Present value of the future cash flows. In case of zero coupon bond, future cash flow. What I get from the zero coupon bond? 1000. I received this 1000 in first year or second year? Second year. I discounted what rate? R2. I discounted rate what to? R2. It is brought to what year? First year. I once again discounted what rate? 10.5. It is brought to year 0. That should be 807.98. Accept or not? Similar to last problem here, correct? No. So, 1000 is the value at the end of the second year. Discounted the second year interest rate, I bring it to the first year. Discounted first year yield of 10.5, I bring it to the year 0. This should be 807.98. Everybody, yes or no? Now, the same 8, that is, I can just rearrange. I get 1 plus R2 is equal to 1000 divided by 807.98 into what? 1.1050. Am I right or not? If I simplify it, I will be getting 1 plus R2 is equal to 1.12. What is R2? R2 is equal to 12%. Respond yes or no. Tell me that means second year yield is how much percent? 12%. All of you do once again, tell me along with the calculation how to do it. I want to calculate the second year forward rate. What is the value of a bond? That is 807.98. Definition, what is the value of the bond? Present value of the future cash flows. What are the future cash flows? 1000 at the end of the second year. 1000 first discounted what? R2 and bring it to first year. Discounted 10.5. As the first year, no, bring it to what? Year 0. I get the return as how much percent? 12%. Everybody following or not? So, a 1 year bond is having a yield of how much percent? 10.5%. A 2 year bond is having a yield of how much percent? 11.25%. On an average, 11.25%. And the second year yield will be how much percent? 12%. Is the understanding up to this? Everybody yes or no? Now, this can be further simplified. Okay, this can be what? Further simplified. Now, same 807.98 I will get. I will get what? Same 807.98 by discounting another way. 1000 discounted at 11.25% for 2 years also gives you 807.98. Correct? Now again I say 1000 divided by 1.12 into 1.105 gives you 807.98. Accept or not? That is 1000 first discounted what? 12%. Bring you to year 1. Discounted what? 10.5. Bring you to year 0. Gives you 807.98. One way of understanding it. Right or not? Now. Other way is 1000 divided by 1.125 the whole square. 1000 divided by what? 1.1125 the whole square. Should I repeat? I'll say once again. See. What is the value of a bond? Present value of the future cash flow. This one yield to maturity or not? Tell me. What is the YTM of a 2 year bond? 11.25. Now I can say like this. 1000 divided by 1.1125 the whole square also should be giving me 807.98. That is how I first found out the price itself. Right or not? என்ன correct? In other words, what is this number? It is 1000 divided by outright 1.1125 into what? 1.1125 also gives you what? 807.98. In other words, discounting at an average yield of what? 11.25 for 2 years will give you the same answer by discounting at what? Specific yields of each and every year. So no, discounting at 12.5%, 12% for what? Second year, and then 10.5% for first year will give you the same answer as discounting at what? 11.25% for 2 years. Ennappa, right or not? Both will give you, should give you the same answer. Are you following what I am saying? This is how I found out the value itself in the first place, right or not? Now, in that case, now can you just believe the slide? The slide is as follows. Alternatively, 807.98 is nothing but 1000 divided by 1 plus R2 into 1.105. 1000 first discount by what? Second year yield, bring it to first year, and then discount by what? First year yield, bring it to year 0 is one way of finding out this value, it or not? Or alternatively, 1000 discount by what? Average yield for 2 years, I'll get the same value. Respond yes or no? Now, in that case, let us equate these two. This 1000 and 1000 becomes irrelevant. This 1000 get cancelled or not? In other words, I can say like this. The denominator 1 plus R2 into 1.105 is equal to 1.125 the whole square. Accepted? Yes or no? 1 plus R2, this denominator can equate because numerator same means the denominator also should be what? Same. Correct? If the numerator is same, the denominator should be what? Same. Okay. In that case, 1 plus R2 into 1.105 is equal to what? 1.125 the whole square. Right or not? In other words, 1 plus R2 is equal to 1.125 the whole square divided by what? 1.105 is equal to how much? 1.12. In other words, R2 is equal to 12%. Is the alternative way of doing this particular problem. I think you're all following or not? That means to do this sum, do I require cash flows? Do I require the maturity value of 0 coupon bond? Not at all. Because the 1000 is, I don't want the 1000, I don't want that 807.98, I don't want any financial detail. With just the 10.5% and what? 11.25% itself, I'll be able to calculate what? Forward rates in this particular sum. Are you following what I am saying? I took the 1000 initially only for you to what? Understand it. Now the 1000 vanishes, 807.8 vanishes. My computation is very simple. The forward rate of second year is what? 1.1125 the whole square divided by what? 1.105 gives you the forward rate for the second year. Everybody, are you following what I am saying? No. So now, you may ask us, sir, why I am not doing this in the previous sum? Why not doing this in what? Previous sum. The problem in the previous sum is, I have multiple uneven cash flows. For example, 2-year bond, if I say first year 1000 and second year 1 lakh, so first year 10,000 and second year is what? 1 lakh 10,000. I cannot take the numerator common outside. Did you understand? Did you understand what I am saying? So, first problem, coupon paying bond, that is the only way to what? Calculate. In this case, I can simply say 1.1125 the whole square divided by what? 1.105 is going to give me the forward rate of 12%. Is the second method. Okay. Now, sir, this is also very difficult. I don't want to do it. Then the third method, as he said, is very, very simple. Now, tell me, what is 2 years forward rate? What is 2 years interest rate? 11.25% per annum. For the 1 year interest rate? 10.5. Now, it's very simple. Forward rate is nothing but 11.25 per annum for how many years? 2 years. That means a 2 year interest rate is 22.5. Minus 1 year rate is how much? 10.5. 22.5 is the interest rate for 2 years and 10.5 is the interest rate for what? 1 year. What the secondary interest rate here? 12%. So R is equal to how much percent? 12%. This is what we call as a bootstrap method. What method? Bootstrap method. Using the second year and first year. How strap? No. Extension what? Pasted. Between second and first year we calculate the forward rates. This method can be used only if the rates given are zero rates. Or the rates given are what? Rates for a zero coupon bond. I cannot apply this for a coupon bond because the numerator is not common. It is a multiple uneven cash flow. Are you following? Those are understanding, raise your hand. Really? Can I? You understood, Appa? Should I explain once again?
This is applicable only for zero coupon bonds, sir.
Yes.
And these types of problem will come only in case of zero coupon bonds or even for multiple uneven bonds, sir.
Multiple uneven bond, to find out forward rates, we require coupons. If the coupon is not given, we cannot calculate the forward rate for a plain bonds or any other bond. Okay, for zero coupon bond, we don't require coupon. We don't have coupon. Simply can use what? Bootstrap method of finding out the forward rates. Now, see. Here, I will say, all over the world, forward rates are quoted. Libor forward rates, US T-bill forward rates. So many forward rates are quoted. Always, whenever they quote the forward rates in the market, they always quote it using the zero coupon bonds. Using what? Zero coupon bond, because market find it very easy to calculate. For the first thing, the layman can understand what the forward rate means. Second issue. And third issue is zero coupon bond will not be influenced by reinvestment rates. That's what I am saying. It is always, the yield is a true yield. The yield is what? A true yield. You need not worry about whether it is a forward rate for a yield or realized yield, because both are going to be what? Absolutely same. It is more believable than what are the other rates. Okay, a 25 year US Treasury bill, zero rates can be used, or a 10-year rates can be used to calculate the forward rates. So whenever they say forward rates, they either use a zero T-bill rate of US or what? Yeah, Libor zero rates will be used to calculate the forward rates for simplicity in the calculations. Everybody following or not? So now we did two problems in forward rates. One using a coupon paying bond, another using what? A zero coupon bond. Now, if all of you have understood, can we calculate forward rate for year 3 or not? No. Now, forward rate for year 3. Please, everybody, tell me. 3 methods you are going to use. Tell me the first method. What is the value of the 3-year bond? Everybody. Just a minute. Stop. Everybody participate. 1, 2, 3, start. Tell me first. What is the value of a 3-year bond? What amount is 7 not? 711 point? Okay. So is equal to, what is the value of a bond? Present value of the future cash flow. Now, what is the future cash flow? 1000. 1000 I discounted what percent? R3. This 1000 is brought to which year? Second year. I discounted 12%, brought to first year. I discounted 10.5, brought to year 0. Accept or not? No. Same 711.78 I can get if I discount the 1000 by, look at the question, tell me 3-year zero coupon bond is how much percent yield to maturity? 12%. Where it is given? Question la. Okay, so that means 1000 discounting this way and 1000 discounting using the average yield. Both should be giving you what? The same number. Respond. Are you following or not? Should I repeat? Now, once again tell me. I'll tell you once again, please. 711.78 is what? Value of a 3-year bond. Now, how much I get the 3-year bond cash flow? 1000. When I get? At the end of the 3rd year. If I discounted R3, what is R3? 3rd year discount rate. All of you respond. The 1000 is not which year? Second year. Second year discount rate is what? Don't say 11.25, that is wrong. 11.25 is what? 2 years average rate. Are you follow what I am saying? So what is the second year discount rate? 12%. We calculated last step only forward rate. Correct? Last time we calculated forward or not. So in that case, 1000 discounted R3 to bring it to what? Second year. That you discounted what? 12%. What is 12%? Second year rate. To bring it to what? Year 0. As a year 1. And year 1 discounted what? 10.5% to bring it to year 0. Respond. Are you following or not? No. This is one way of doing it. Or other way is, the 3-year zero coupon bond is having an average yield of how much percent? 12%. Given the question or not? So 1000 divided by 1.12 power 3. If I simplify it, I'll be getting 1 plus R3 into 1.12 into 1.105. This 12 and this 12 don't get confused. This 12 is what? Second year forward rate. This 12% is what? 3 years average rate. Coincidentally same in this sum. That's all. Are you following or not? Now, if I rearrange, I'll be getting 1 plus R3 is equal to 1.12 the whole cube divided by 1.12 into 1.105. The answer is how much percent? 1.135. What is the forward rate? 13.5%. Respond. Are you following or not? The other method is much more simpler. Call as what method? Bootstrap method. How to use bootstrap method? Tell me. 3 years, the interest earned is 3 into 12%, 36%. என்னையா சொல்லுப்பா, every year 12% per annum, how many years? 3 years. 3 years interest is 36%. 2 years interest is 2 into 11.25 gives you what? 22.5%. So 3 years interest minus 2 years interest gives you the third year interest or not? So the 3 years interest is every year 12% for 3 years, 36%. If I invest in a 2-year bond, I earn 11.25% for 2 years, 22.5%. The third year I am earning a rate of how much percent? 13.5%. This method I call as what method? Bootstrap method for calculating the forward rates. Yes or no? No. When can I use a bootstrap method? One and only if the forward rates are zero rates. I cannot apply it for a coupon paying bonds, yield term structure or yield to maturity data. Everybody following or not? So now tell me, there are two types of forward rates problems in the examination. One is in exam where they give you what? Coupons. In exam where they give you only the yields. When they give you coupons, do the problem in the manner discussed in question number 17. When they give you only yields, you have to assume that number to be what? A zero coupon bonds yield to maturity, and then do the bond as a problem using either the bootstrap method or the other two methods also, and the last method is much more simple and convenient. Everybody following or not? Now all this will be revisiting with much more intricate calculations towards the end of the batch. I will be discussing the area called as swap valuation, where the same thing shall be calculated once again. Up to this, everybody have the clarity here? Now, so please start copying this now. Give the heading forward rates. If I am right, you should have copied the first slide, right or not? No. Second is forward rates. Those not copy, raise your hand. Can I proceed? Alternatively, finish copying, huh? Stop talking, please. Those not copy, raise your hand. Shall I proceed? Can I proceed or not? No. So, this is very simple. Tell me how to understand it here. 2-year bond gives you an interest on 11.25% per annum. What is the interest totally given? 22.5. 1-year bond gives how much interest? 10.5. So the difference is 12% the second year interest. Small slide here, finish copying. Shall I proceed? Can I proceed? No. Finish copying. Shall I proceed? Write down note. Write down notes. Point number 1. Point number 1. If in the problem coupon rates of bonds are not given, if in the problem coupon rates of bonds are not given, if in the problem coupon rates of bonds are not given, then coupon rates of bonds are not given, then the YTMs can be assumed to be, then the YTMs can be assumed to be, then the YTMs can be assumed to be what rates? 0 rates. Then the YTMs can be assumed to be 0 rates. Then the YTMs can be assumed to be 0 rates. Can I proceed? Point number 1 or 2? 2. In case of 0 rates, the forward rates can be calculated easily using, in case of 0 rates, the forward rates can be calculated easily using, the forward rates can be calculated easily using, bootstrap method, B-O-O-T, boot, hyphen, S-T-R-A-P, strap, within quotes write bootstrap method. The forward rates can be calculated easily using bootstrap method. Can I proceed or not? Write down. For example, forward rate for year 5 is equal to, not this sum, generally I am saying, forward rate for year 5 is equal to, 5 5 years into YTM of 5-year bond, 5 years into YTM of 5-year bond minus, can I fill in the blanks? Minus what? 4 years into YTM of 4-year bond, 5 years into YTM of 5-year bond minus 4 years into YTM of 4-year bond divided by 5 minus 4. Divided by 5 minus 4. Divided by 5 minus 4. Everybody, are you following or not? Now. Bootstrap method, last point, 3 or 4? 3. Bootstrap method should not be applied to term structure of coupon paying bonds. Bootstrap method should not be applied to term structure of coupon paying bond. Should not be applied to term structure of coupon paying bond because term structure of coupon paying bonds because the cash flows are uneven. Because the cash flows are uneven. Here we had 1000 common numerator, hence the rupee value became irrelevant in my calculation, right or not? But there the cash flows are uneven. That is the reason why we cannot apply this method. Now, I think one more part of this question is there. Let us answer it together and then go for the next one. This part, I want you to answer me. I want to check whether all awake or not, whether understood or not. Okay, let's take question number part 2 of this question. Let me read and you tell me what to do. If the interest rate increases by 50 basis points, all of you answered. 50 basis point means what? 0.5%. What will be the percentage change in the price of the bond having a maturity of 5 years? Assume that the bond is fairly priced at the moment at rupees 1000. My question is, tell me, what is that we have to calculate first? The question asks you to calculate what first? Volatility. Correct. Good morning, friends. What is volatility? Tell me. If the formula, meaning what meaning of volatility? If the yield changes by 1%, how much percentage point the bond price changes? That is the question, yes or no? Always alert to the question. What is the question? If the interest rate, that is yield, increases by 50 basis point, what will be the percentage change in the price of the bond? That's all. Are you following? Correct? Now. So now the bond is having how many years maturity? 5 years maturity. 5 years maturity bond will be having a duration of how many years? Why 5 years? Zero coupon bond. Duration is equal to what? Maturity. Yes or no? And look at the previous page. 3 years and above. 3 years and above. What is yield maturity? 12%. So the 5-year bond is trading at an yield of how much percent? 12%. YTM is equal to 12%. Duration is equal to how much? 5 years. So what is the formula for volatility? Duration divided by 1 plus YTM. We know the volatility into 0.5 gives you what? Percentage in the bond price. Are you following? Yes or no? Grip should be such a way that anywhere, anything they ask, will be able to what? Apply and write it. Are you following? Now, again here only I wanted to highlight bond valuation chapter. Now we are doing. We are now in full form or not? Now, assumed, yeah, right or not? Now, yeah, at least we are in some form now today. Yes or no? Now, at this stage itself, during a forward rate problem, if they ask a question about volatility, we are not able to immediately recollect an answer. Right or not? Think about a situation after 3 months, after completing forex, bond valuation, derivatives, futures, options, swaps, portfolio management, capital budgeting, leasing, that chapter names here, mergers and acquisitions, all this completed here. If they ask a bond question, we have to recollect everything and answer or not. At that time also, how you remember immunization now, the same memory should be there, right? Everything is the ability to immediately what? Link and then what? Take it and answer the question. That's a very important point that will come only when you do constant revision. I am just saying the emphasis on revision only. Revision is as important as attending the class. Will you all do it or not? Are you all revising now on regular basis? Till now what is done in bond, are you all revising? IFM finished revising? During bond also have a plan to revise some concept in IFM. Money market rates with euro rates, remember? Leading how discount should be offered, remember or not? No. So like that you have to revise. Can I proceed? Write down. Next. Part B or part 2 as a case may be. Volatility of a 5-year zero coupon bond. Volatility of a 5-year zero coupon bond. Underline that. Volatility of a 5-year zero coupon bond. Underline that. Right. YTM is equal to, questionly given here, YTM is equal to how much percent? 12%. YTM is equal to 12%. YTM is equal to 12%. Duration is equal to how many years? 5 years. Duration is equal to 5 years. In bracket, right? For zero coupon bond, duration is equal to 5 years. In bracket, right? For zero coupon bond, duration is its maturity. For zero coupon bond, duration is its maturity. Volatility is equal to, right, the formula. Volatility is equal to what by what? Duration by 1 plus y. Volatility is equal to d by 1 plus y. Duration by 1 plus y. Which is equal to 5 divided by, number right above, 5 divided by 1.12. Is equal to 5 divided by 1.12 is equal to how much? How much it is? 4.46 is equal to 4.46 is equal to 4.46. Write down. Next. When YTM changes by 1%, when YTM changes by 1%, when YTM changes by 1%, the bond price inversely, next what? Approximately changes by, the bond price inversely approximately changes by how much percent? 4.46%. Inversely approximately changes by 4.46%. Therefore, when interest increases by 0.5%, therefore, when interest increases by 0.5%, when interest increases by 0.5%, the bond price will decrease by, interest increases, bond price will decrease, the bond price will decrease by, 0.5 into 4.46, decrease by 0.5 into 4.46 is equal to how much? 2.23%. The bond price decreases by 2.23%. 2.23%. Everybody have the clarity or not? Now, with this, we have completed this concept called as forward rates. 2 sums done. Question number 17, question number 18. 17 is for what bond? Coupon paying bond. Question number 18 is for zero coupon bond. One sum I have given us homework. What is the sum? Question number 16. I don't have the answers with me, but you can just solve it. It is something similar to question number 17. This is question number 16. Tell me, in question number 16, can I use bootstrap method or I cannot use bootstrap method? Why cannot use bootstrap method? Because they have given you the coupon rates. Now, what you should do is calculate the YTM, that is the forward rate for second year, third year, fourth year, fifth year. I did not do the sum because I have to do 4 forward rates. Hence, this is question number 17 to save time. So, can you do this sum on your own or not? So, do it as homework, and if you can, get a check from me. Okay. So, with this, we complete the concept of forward rates. Now, Please. Another very regularly asked sum in the examination is this bond refunding decision or the callable bond concept. Okay, please. See, a company suppose has issued a 10-year bond, say at a coupon rate of 12%. Stop talking. A company has issued a 10-year bond at a coupon rate of 12% because that was a prevailing expectation of the public and it has been issued at 12% coupon. Now, 5 years has passed. Okay. After 5 years, everywhere the interest rates have dropped. Throughout the country, interest rates have dropped. Now the current prevailing interest rate, suppose is only 9%. How much percent? 9%. Tell me, this company is having a disadvantage in its cost of capital or not? Because it is paying to its bondholder a 12% coupon, whereas everybody is expecting only how much? 9%. See, one thing is, for the bondholder, the bond will be trading at a higher price. I don't know it because 12% bond, right or not? 12% coupon bond, YTM is only how much? 9% expecting, means for him the bond will be trading at what? Higher price. He may make a capital gain or can enjoy what? Higher coupon. This for him, a company is bleeding, yes or no? Whether bond is trading at 1,000 rupees or 100 rupees, company not worry because it has to pay every year how much coupon? 12%. Whereas the market expectation for the interest only how much? 9%. In such case, the company will be unhappy about this bond issue, right or not? This may happen for a very long-term bond, a 5-year bond or a 10-year bond, 25 years bond, all this bond, like this a situation may come for the company, right or not? In such case, at the time of bond issue itself, in the bond indenture means the contract. It is also a contract between the fund provider and the company or not. In the bond terms itself, they may add a clause saying that company will have the right to repurchase the bond anytime it wants. Are you following? Like that, if an option is there, it may be there, may not be there. If like that a clause is there, then the bond is called as callable bond. It is called as what bond? Callable bond. The word call means buying. The word call means what? Buying. Okay. So here, when the company has in its indenture a clause saying that company has a right to repurchase the bond anytime it wants, such a clause will be called as what clause? Such a clause is called a repurchase clause. The bond will be called as a callable bond. Okay. In that particular sentence or clause, they also say if it wants to repurchase earlier, rather than keep it till redemption, then they cannot purchase at a par value. They should give some premium for the repurchase or no. In the case, we will be purchasing back at 5% premium or 10% premium. That premium on repurchase also will be quoted in the bond indenture itself. Are you following? Not I am saying one type of instrument called as callable bond. Tell me, normal bond, company issues a bond for 15 years. In normal bond, company can redeem only at the end of what? 15th year. Till that time, whether crying or happily, it has to pay what? The coupons are interest. Yes or no? If the company wants to protect itself, then the company can issue a bond where it is for 15 years. But if the company wants, can redeem at the end of 15th year or can also repurchase a bond earlier at a premium stated in the indenture itself. Yes or no? Such a bond having this particular clause will be called as what bond? Callable bonds. Now, see. In this case, when a company is having a callable bond, it has to make a decision whether to repurchase or not on a given date. Yes or no? Today, suppose everywhere interest is 9%. For me, the interest how much percent? 12% I am paying. Tell me, when I repurchase, what advantage? Repurchase, very simple. 3,000 crores bond, suppose is there, means what I can do is I will repurchase a 3,000 crore bond and then what? Reissue the bond. I'll purchase and what? Reissue. I purchase the bond and reissue back at what percent coupon? 9% coupon. That's the main aim of purchasing back. I want money because my business is going to run, but I'm going to replace the old bond with what? New bond, where the old bond carrying a 12% coupon will be redeemed. Will be what? Redeemed. And the new bond carrying what? 9% coupon will be replaced. This decision is called as bond replacement decision or bond refunding decision. Refunding means a 12% bond is now funded by what? A 9% bond. It is pushed out and this comes and sits in its place. Are you following? Now, in this replacement, don't think there is only advantage. There are also outflows involved. The outflows are very simple. The old bond has been redeemed or not? Can I redeem a para? No. I have to pay what? Some premium. I have to pay some extra money for redeeming it. Similarly, when the new bonds are issued, I'll be having issue cost or not? And then flotation cost, I can sometimes have to issue new bond at what? Premium and so on. In that case, there's a cost of issuing the new bond. There's a cost of redeeming what? Old bond. All this I should consider the cost as well as benefit. If the benefit is more than cost, go for the replacement decision. If the benefit is not more than cost, continue with the old bond itself. Is what we call as replace or not decision problem in the examination. Everybody following? Any issue? No. For that we have to see the NPV of this decision, and if the NPV is positive, replace. Negative means don't replace. In IPCC, old machine replace with new machine. Replace and problem is there or not? Same way here also, old bond replace with new bond. Is it good or bad is a question. About that we will be doing a problem. More can be understood by actually doing the calculation. Respond, yes or no? Tell me. Number one, bonds can be of two types. Bond having a right given to the company to call back anytime, and bond where the company does not have a right to call back anytime. If they have a right to call back anytime, what is the motivation of the company to call back a bond? Because a bond carrying 12% can be replaced with what? A bond carrying a coupon of 9%. There is always a coupon saving that is possible. At the same time, it is having also some cost involved. Above that, one will be doing in the next sum. Can do that particular problem or not? Take question number 26. 27. Okay, workbook and then question number 27. Notebook question number 27. Okay. Okay. Magnavision Electronics has 300 million 16% bonds outstanding with a balance maturity of 5 years. As interest rates have fallen, Magnavision can refund its bonds with a 300 million issue of 5-year bonds carrying a coupon of 14%. The call premium will be 5%. Can redeem at para? Have to pay more to the old bond holders? More. How much percent more? 5%. The issue cost of the new bond will be 6 million. The unamortized portion of the issue cost of the old bonds is rupees 5 million, and these can be written off no sooner the old bonds are called. Magnavision's marginal tax rate is 35%. Analyze the bond refunding decision. I'll just give you a few minutes time. Go through the question for the facts, then we can just start with the solution. Shall we start or not? No. See, this company is at present having a bond worth how many million? 3,000 million means, that is 300 million means what? 3,000 lakhs. It is 3,000 lakhs bond they are having. What is the current coupon for that? 16%. And how many years maturity? 5 years. Everywhere now the interest rate is 16%, drop. It has dropped to how much percent? 14%. Now the company wants to replace the 16% bond with what? 14% bond. And in that case, it has to do two things. One is to redeem the old bond and then issue the new bond. When I redeem the old bond, can I redeem by giving exactly 300 million or extra? I have to redeem at what? 5% premium. At the same time, when the new bonds are issued, will I get the entire amount in my hand? No. Because I have to spend how much as the issue cost? 6 million as the issue cost of the new bond. And further, old bond is still having in its balance sheet an unamortized amount of 5 million. It would have been issued earlier at what? Some discount or there may be some amortization left out. All the still left is how much? 5 million. This is all the issue that has been given. Now the tax rate also given as 35%. Should I replace a new bond, old bond with the new bond? Should I or I should not? That's a question, yeah, okay. Yes, no, the answer, they wrongly said, should I should not? It all depends on the cost and benefit. NPV positive means replace, negative means what? Do not replace. Is the answer, respond, yes or no? That means I have to calculate what? Net present value. Something similar to a capital budgeting problem. Can I present or not? No. We do capital budgeting for the asset side. For a change, I am doing for what? A liability side. We discuss about replace or not of an old mission. I am replace or not for what? A old bond I am discussing. That's all the change. Everybody, can you start or not? Think that depreciation is going to be amortization. Can you present or not? Can you start with the solution? No. I will do it and then give you time to copy it. All of you participate. Please. No need to copy. Please participate. Okay. Here, even cash flow in lakhs I am writing. Okay. First, please. Year 0, cash outlay. Year 0 is cash outlay. I will do the working in the sheet and then put it in the slide. When you copy, you will be having an integrated way of having the working notes. Can I present or not? Let me do the first. Now, initial outlay. Tell me two things I am going to do. One is what? Old bond. Another is what? New bond. This is going to be redeemed and this is going to be what? Issued. Redemption results in inflow or outflow? Outflow. And new bond issue results in what? Inflow. Can I proceed? Now, tell me the outflow here. First, I have to redeem the old bond. Now, I have to redeem the old bond at par or premium? Okay. What is the face value of the bond? 300 million means what? 3,000 lakhs. I redeem at how much percent premium? 5%. What is 5% of 300 lakhs? 150 lakhs. That means what is the amount here? 3,150. This is an inflow, outflow, outflow. Everybody, are you following or not? No. Similarly, new bond, I am going to redeem a issue, issue. When I issue to the bondholder, they did not say any other thing, issued at par only. How much a bondholder gives me? 3,000 lakhs. Okay. Can I take home 3,000 lakhs? No. Because in that I have to incur what? Issue cost. What the issue cost of the new bond? 6, how much million? 6 million means how many lakhs here? 60 lakhs. So the issue cost how much lakhs here? It is going to be 60 lakhs. Okay, tell me, what is the net outflow here? 2,940 lakhs. Is the inflow, outflow? Inflow. Are you all able to understand or not? See, through new bond issue, the money that comes to your mind is only hand is only how much? 2,940. 3,000 lakhs the bondholder gives me, no doubt, but I have to spend for issue how much? 60 lakhs. What is in my hand is 2,940. But to the other party, I have to give them how much? 3,150. Can I use the entire process to refund? No. I have to put my own money extra or not? Tell me, what is the extra outflow I'm going to have? It is going to be how much lakhs here? 210 lakhs. Inflow, outflow. This is year 0, initial investment. Respond. Are you following? To save the future year's interest, this money I have to sell it today out as an initial investment. Everybody following or not? Now, let's put it here. Now, cash outlay in year 0 is how much? 210 lakhs. First issue, are you following or not? Now. Now, the remaining years are going to give me what? Inflows. Like capital budgeting only. Year 0 is a outflow. The remaining years are inflow. Okay. First year, let's take the first year. In first year, I am going to have tax savings. I am going to have what? Tax savings on 2 amortizations. On what amortization? 2 amortization. Now, old bond continues, old bond gone. When something is gone, whatever debits of that is there, you can put in the P&L account. Yes or no? When a machinery is sold here, the balance asset cost can be written up to the P&L account or not? Like that. When liability ceases to exist, then all the unamortized portion of the liability can be what? Amortized in one single year in the end of year 1. Yes or no? Even though I just, what I say, scrap the bond today, the tax benefit cannot be enjoyed today. It comes only at what? End of the year. So don't say TDS advance tax and all. Year-end tax I assume. But the is only at what? End of the year. Right or not? Tell me. 2 things are there. Old bond, unamortized portion, 5 million there. Right or not? In the balance, suppose old bond has been issued 8 years back here, having an issue cost or not. The issue cost year after year, I'll be debiting to what? P&L account on an amortized basis. Are you following not? Still, how much is unamortized? 5 million. The 5 million can continue in the balance sheet. That should be written off immediately. Written off immediately. It will jump to P&L. Yes or no? When something is debited in P&L, what happens here? Tax is saved. Yes or no? So, first of all, I will amortize the unamortized portion of what? Old bond. How much lakhs? 50 lakhs. On the 35% tax is saved. Accepted? Yes, number 2, old bond is now redeemed the premium. 3,000 rupees bond. I redeem at what? 3,150. 150 premium redemption. Yes or no? Can I amortize over next 5 years immediately? Immediately, because the premium redemption comes not from the new bond, from what? Old bond. It should also be debited immediately. Are you following what I am saying? In that case, in my P&L this year, I have 2 debits as amortization. One is what? The unamortized old portion, and number 2 is what? Premium redemption. On both, I will be making a tax savings. Accepted? Yes or no? In that case, see, year 1, tax shield on unamortized portion of old bond. Calculated. Take the calculator. How much is the old bond unamortized portion? 5 million. Means how many lakhs here? 50 lakhs. Into how much percent? 35%. Multiply and tell me 50 lakhs into 35% is how much here? 17.5 lakhs. Okay. Now, any more debits are? Yes. What's the next debit? Premium redemption of the old bond. So, what is the premium redemption? How much lakhs? 15 lakhs. 15 lakhs. 150 lakhs. 150 lakhs in how much percent? 35%. Tell me what is the amount here? 52.5 lakhs. These 2 items are nothing but tax savings I have by having some debits in the P&L. Because when I debit the money in the P&L, the profit increases or decreases? Decreases. When the profit decreases, tax can be saved. So much tax can be saved on these 2 issues. Everybody, are you following up? Now, apart from that, every year I get some savings in interest or not? Yes. How many years here? 5 years. Interest savings after tax. Okay, very simple. All of you, I will do it here. Point number 2. Okay. What is the face value on which interest will be calculated? 3,000 lakhs. On which, earlier I was paying how much interest? 16%. Now I have to pay only how much interest? 14%. I save how much percent? 2%. Savings is inflow, outflow? Inflow. But can I take entire 2% home? Because when I save interest, the profit goes up. When profit goes up, tax also goes up. So when I say interest saved, I say interest saved after tax. How to bring it after tax? Into 1 minus 0.35 or into 65%. Yes or no? Rumba simple. 2 rupees if I save, 35% of 2 rupees is what? Gone to government. What I save is balance only 65% of 2 rupees. Are you follow what I am saying? In that case, 1 minus 3 brings you after tax. If I multiply, tell me 3000 lakhs into 2% into this gives how much? How many days? 39 lakhs. That is going to be the interest savings 1 year, 5 years. Single annuity savings I am going to have this way. Everybody following or not? No. In that case, very simple. So what is the interest saving after tax? It is how much lakhs here? 39 lakhs. How I calculated? 2% on 300 million I have saved. In how much percent? 65%. I wrote in lakhs. How many lakhs here? 39 lakhs. Everybody respond yes or no? No. And one more thing. I have an incremental amortization. Because old bond unamortized only 5 million. Had I continued with the old bond, my amortization only how much? 5 million. New bond, I have 6 million to amortize. Yes or no? No. Suppose I did not go for the new bond. I continue with what bond? Old bond. Then I will continue to amortize how many million? 5 million. 50 lakhs for how many years here? 5 years. Due to new bond, I am able to amortize how many million? 6 million. How many years here? 5 years. That means for the 1 million, I have an extra amortization which is going to save me tax. Right or not? In that case, very simple. I will calculate here. This is number 3. Now, old bond, I will be amortizing how many lakhs? 50 lakhs. For how many years? 5 years, 10 lakhs. This I will do if I have not redeemed. If I have not redeemed, I will be getting an amortization of 10 lakhs every year. Right or not? But due to new bond, I am not amortizing 5 million. I am able to amortize how many million? 6 million. How many lakhs here? 60 lakhs. For how many years? 5 years. How much I get? 12 lakhs. Due to the new bond, what is the extra amortization? 2 lakhs. This 2 lakhs can save me how much tax here? 35% tax. Everybody yes or no? Because when I debit 2 lakhs every year extra, I save how much tax? 35% tax. How much is here? 70,000 rupees or 0.7 lakhs. Everybody, are you comfortable or not? In that case, in the last calculation, it is year 1 to 5, every year I am going to get extra amortization, tax amortization and increase amortization is going to be how much lakhs here? 0.7 lakhs. Everybody following or not? Now, all these are the benefits of going for the redemption, and the initial investment is 210 lakh. Can I say 210 minus 17.5 minus 52.5 into 5 minus 39 into 5 minus 0.7 gives you NPV. True or false? False. Time and life money prevents me in what? Adding or subtracting. I should discount. I should what? Discount. Everybody, are you following up to this or not? Now, before I go to discount rate, tell me, I am now replacing what with what? New bond with old bond. Sorry? Old bond with new bond. Can I proceed or not? Due to this, what are all the cash flow that occurs for me is what I am saying. Yes or no? First, year 0, I have to give back the old bond of how much lakhs? 3,150 lakhs. And I have to issue the new bond at 3,000 lakhs. 60 lakh goes for what? Issue cost. What comes to my hand is only what? 2,940. So due to the replacement, I have to pay how much lakhs? 210 lakhs extra out of my pocket. Year 0. Yes or no? No. What happens is, in first year, I amortize 2 things straight away fully. One is what? Old bond, 50 lakhs unamortized, I debit back to P&L, and old bond premium redemption, 150 lakhs, I debit to P&L, on which I am saving the tax of 17.5 and 52.5. Every year, I pay 2% less interest on how much lakhs? 3,000 lakhs. For how much percent? 65% because 35% goes for tax payment. So, and this is going to be the annual savings I am going to have. Yes or no? And the last is, had the old bond not been redeemed, I will be amortizing how much lakhs? 50 lakhs. Due to the new bond, I will be able to amortize how much of it? 60 lakhs. So 10 lakhs extra amortization I am getting over how many years period? 5 years period, on which I save a 35% tax of 0.7 or all the cash flows associated with the bond replacement. Respond yes or no? No. I should discount or not? So I should discount or not? Tell me. I should discount at what rate? No, Sulupa, I should discount at what rate? 14 or 16? Why not 16? 16 is not the current expectation. Discount at the required yield. Today, the bond holders are expecting from this bond how much yield? 14%. So the appropriate rate is not the past rate, it's only what the current rate. The current interest rate is the market how much percent? 14%. Discount at what rate? 14%. But the problem is the cash flows are before tax or after tax. The cash flows are after tax. After tax cash flows should not be discounted using before tax rate. Should be discounted using what? After tax rate. Ennappa, yes or no? Now, after tax cash flow should be discounted at what rate? After tax rate. Before tax using what rate here? Before tax rate. Everybody, are you following? Huh? This rule you all know or not? Do you all know the logic for this rule? Huh? Now I'll tell you once again, just to have a clarity, and then go for the discount rate. I'll just give a small example. Okay. See, simple example. There is a 3-year bond today trading at 1,000 rupees. Okay, par trading. First year, second year, third year gives a coupon of 120, 120, 120. Third year redeems at 1,000. Okay, tell me what is the IRR? 12%. What is the IRR here? 12%. Trading at par, redeemed at par, IRR should be 12%. Yes or no? Yosikariya. That means I can say the IRR is how much percent? 12%. Other words, I can say bond gives its bond holder a return how much percent? 12%. In other words, if I discount the bond cash flows are how much percent? 12%. I get a bond price. Now, suppose here cash flow 0. How much invested? 1,000. 120 rupees I get interest. But the income tax rate of, for example, 50%. Easy understanding. What income tax rate here? 50%. That means the bond holder gets in first, second and third year 120 and 60 rupees are 60. 60, 60 and then what? 60. Third year how much he gets? 1,000. So this is before tax, after tax, after tax. Tell me what is the IRR? How percent? 6%. Now I can say he is earning 12% before tax and 6% after tax. He is earning what? 12% before tax and 6% what? After tax. Yes or no? Now, if I discount so if I calculate IRR for a cash flow without tax, the return is what? Before tax return. If I calculate an after tax cash flow using if I calculate IRR, it becomes what? An after tax return. Yes or no? Other words, same 1,000 bond value I can get by discounting at 12% or 6%. If I take a before tax cash flow, I should discount using what? Before tax return. If I take an after tax cash flow, I should discount using what? After tax return. If I discount this using 6%, I will not get the bond price correctly. Yes or no? Because you cannot expect an after tax return from before tax cash flow. Yeah, correct. Discounted at required rate of return. Cash flow should be discounted at what? Required rate of return. If a required rate of return, what you want is an after tax return. The cash flow should also be what? After tax. So no. What you want is what? Before tax return means the cash flow also should be what? Before tax. You cannot discount the before tax cash flow with what? After tax. It is illogical. Are you following? So always what cash flow should take, that discount rate should be taken, because you cannot expect an after tax return from before tax cash flow. The tax has to be paid. Yeah, correct what I am saying? In that case, or we cannot expect a before tax return from what? After tax cash flow, because this cash flow cannot give you what? A before tax return is very abnormal. Yes or no? In that case, after tax cash flow should be discounted what? After tax return, and before tax cash flow by before tax return. This concept everybody following or not? Is IPC concept? Yeah, right or not? Now tell me, should I discount in this sum at 16% or 14% or first step 14%? Because 16% is old yield, the current yield is what? 14%. So the investors requires 14%, yes or no? This 14% they want as a return before tax, after tax, before tax. Now coupon is always what? Before tax. Yeah, they want a 14% yield what? Before tax. But there is a 35% tax or not? Because I have taken tax shield and all here. Yes or no? In that case, I want how much percent after tax here? 14% into 65% after tax should be the discounted to be used. Everybody, yes or no? What should be discounted here? 9.1%. Everybody following? in the discount rate is going to be a very, very critical issue in number of chapters to follow, whether it may be portfolio management, leasing, etc. Now everybody have the clarity or not? Now tell me, I should discount all these cash flows at how much percent? 9.1%. Why 9.1%? 14% is the current yield. Since the cash flows are adjusted for tax, I should not take what? Return before tax. I discount using what? Return after tax. Hence discounted 9.1%. Everybody, are you having the clarity or not? Should I repeat? Can I proceed? Those who want to repeat, raise your hand. I think I did not see any hand. My eyes right? Okay. Can I proceed? Now. Yarba? Okay. From where should I repeat here? Discount rate. Okay. Once again tell the discount rate. Very simple. I don't mind repeating because get it right now itself so that we are not getting confused in the later session, other chapters. Okay. See. Very simple. There's a bond which is trading at 1,000. 120, 120, 120, 120, how many years? 3 years coupon, and third year 1,000 redemption. Now, we calculate IRR, it is how much percentage here? 12%. I can say like this. This bond gives a 12% return to its bond holder. Accept or not? This is a return before tax, after tax, before tax, because in the coupon tax payment is not considered. Yes or no? Now, take the other issue. Suppose tax is 50%. Will he get 120 or 60? Company will pay him 120. He earns only how much? 60. Okay, 60,000. He earns how much return? 6%. Now, see, I can say like this. The same bond gives 12% return to the bond holder before paying tax and gives what? Only 6% return after paying tax. Can I proceed or not? Now, as a corollary. Now, when I want to find out the price of the bond, see what cash flows are used. If I have the before tax cash flows, I should discount at a before tax required rate of return, because if I discount it after tax required rate of return, the problem is I cannot expect an after tax return from before tax cash flow. Right or not? Now, I cannot expect an after tax return from what? Before tax cash flow, or a before tax return from what? After tax cash flow. If the cash flow is before tax, my expectation return also should be what? Before tax only. Because the cash flow, I have not paid tax, I should not expect tax to be paid here. Yes or no? And if I expect an after tax rate of return, that they say the cash flow also should be what? After tax. So simply, before tax cash flow should be discounted at before tax, and after tax should be discounted at what? After tax. If I discount this 120 at 6%, I will not get the bond price of what? 1,000. I get the same 1,000 bond price if I discount 120 at 12% and 60 at 66%. Everybody having the clarity or not? That is what I am discussing in this sum. In this sum, 16% is the old coupon. The new coupon is what? 14%. So the current yield the investors are wanting is how much percent? 14%. But 14% is the yield expected before or after tax? Before tax. So what is after tax here? 14% into 65% gives you 9.1% after tax. Everybody following up? Now, if I just continue further, what a present value factor for year 1? Year 0, 1. Year 0 is 1. 210 into 1 gives you 210. Year 1, take the calculator, 1 divided by 1.091. 1 divided by 1.091 gives how much? 0.9166 into 17.5 plus 52.5. Both comes in what? Year 1. I am going to get 64.16. Check my calculations. Next, 1 to 5 years PV factor or annuity factor? Annuity factor. 1 divided by 1.091 is equal to 5 times GT. What's the number here? 3.8796. So 39.7 into that number gives you 154.02. Now the NPV is how much? 8.18. Replace or don't replace? Replace, because the discounted inflows exceed what? Discount outflows. So it should be replaced. Everybody, are you all following or not? With this we complete the bond refunding decision problem. Everybody, yes or no? Yes, now copy this particular slide. Then I'll dictate the working notes. Give the heading. I think it's question number 27. Question number 27. Shall I proceed? See, these two you need not copy. The two workings, I'll dictate it separately. Okay, interest savings as well as the tax savings on amortization. After that class. Finish copying, huh? Finish copying, huh? Those who are not copy, raise your hand. Stop talking, please. A little bit fast, please. Shall I proceed? Write down. Working notes. Write down working notes. Working notes. Point number 1. Initial outlay. Working notes. Point number 1. Initial outlay. Initial outlay. Branch it into 2. Old bond redemption. First branch, right? Old bond redemption. Second branch, new bond issue. Old bond redemption and new bond issue. Old bond redemption, put the down mark and write par value 3000 lakhs. Old bond redemption, put the down mark and write par value 3000 lakhs. Add what? Call premium. Add call premium 5% at 5%. Add call premium at 5%, 150 lakhs. Call premium at 5%, 150 lakhs. Tell me what is the total? 3,150 lakhs. Total is 3,150 lakhs. Is it inflow or outflow? Outflow. Write it as outflow. New bond issue. Write down. Issue proceeds 3,000 lakhs. They did not say anything, hence I assume to be issued at par. Okay, issue proceeds 3,000 lakhs. Minus what? Issue cost. Issue proceeds 3,000 lakhs minus issue cost 60 lakhs. Minus issue cost 60 lakhs. Tell me what is the net proceeds? 2,940 lakhs. Net proceeds 2,940 lakhs. Inflow or outflow? Inflow. Block these two and say net outlay. Net outlay 210 lakhs. Net outlay 210 lakhs. Net outlay 210 lakhs. Can I proceed or not? Next, point number 2. Amortization in first year. Amortization in first year. Amortization in first year. 3 columns. Particulars, computation, amount. Amortization in first year. 3 columns. Particulars, computation, amount. Okay. Can I start or not? In particulars, right? Tax savings on unamortized portion of old bond. Particulars, right? Tax savings on unamortized portion of old bond. Tax savings on unamortized portion of old bond. Computation, how much money remain unamortized? 50 lakhs. In how much percent I save tax? 35%. 50 lakhs into 35%. 50 lakhs into 35%. Tell me what is the number? 17.5 lakhs. Amount 17.5 lakhs. Tax savings on writing off premium on redemption. Tax savings on writing off premium on redemption. Tax savings on writing off premium on redemption. So go to the calculation. How much premium on redemption here? 150 lakhs into 5% na 150 lakhs into 35%. 150 lakhs into 35%. What's the amount? 52.5 lakhs. 52.5 lakhs. This is the first year. Can I proceed? Next. Point number 3. Interest savings after tax. Interest savings after tax is equal to, straight away, right, is equal to, what is the face value? 3,000 lakhs into how much percent I saved? 25%. 3,000 lakhs into 2%. 3,000 lakhs into 2% into 100 minus 0.35 or 1 minus 0.35. Sorry, 2% into 3,000 lakhs into 1 minus 0.35. 1 minus tax rate. 1 minus 0.35 is equal to, what is the amount I are going to get? 39 lakhs. Is equal to 39 lakhs. Point number 3 or 4? 4. Tax savings on incremental amortization. Point number 4. Tax savings on incremental amortization. Tax savings on incremental amortization. Underline that. Right first. Amortization with old bond. Amortization with old bond is equal to 50 lakhs by 5. 50 lakhs by 5 is equal to how much lakhs? 10 lakhs. That is, if I had continued with the old bond, I would have still amortized how much lakhs? 10 lakhs. Amortization with the new bond. Amortization with new bond, 60 lakhs by 5. Amortization with new bond, 60 lakhs by 5 is equal to 12 lakhs. 16 lakhs by 5 is equal to 12 lakhs. Answer my question. Incremental amortization. What is incremental amortization? 2 lakhs. Incremental amortization 2 lakhs. Tax savings is equal to 2 lakhs into 35%. Tax savings is equal to 2 lakhs into 35% is equal to how much? 0.7 lakhs. Tax savings is equal to 0.7 lakhs. Are you comfortable or not? Next. Point number 4 or 5? 5. Discount rate. Point number 5. Discount rate. The current before tax yield. The current before tax yield expected by investors is, the current before tax yield expected by investors is how much percent? 14%. The current expected yield, the current yield expected by investor is 14%. And since the cash flows are after tax, and since the cash flows are after tax, a simple example, 2% interest saving, I did not take it fully. I took it only after what? 35% tax loss. Are you following what I'm saying? So I had to always use the after tax. Okay. Since cash flows after tax are considered, since cash flow after tax are considered, use after tax discount rate of, use after tax discount rate of, use after tax discount rate of 14% into, use after tax discount rate of 14% into any number. If you multiply by 1 minus t, I will be getting what? After tax. 14% into 1 minus 0.35. 14% into 1 minus 0.35. 14% into 1 minus 0.35 equals how much percent? 9.1%. Equals 9.1%. Equal 9.1%. So very simple. A number before tax, how to make it after tax? Into 1 minus t. A number after tax, how to make it before tax? Divided by 1 minus t. Everybody, are you following or not? No. With this, we have completed this particular area called as what? Bond refunding or replacement decisions. Can I move to the next slide or not? No. Give that thing convertible bonds. Give that thing convertible bonds. Give that thing convertible bonds. Shall we start or not? No. Understand that we are doing that chapter with a structure, with a learning objective, right or not? If we see the learning objectives, we have completed value, YTM, duration, volatility are the 4 types of bond. Stage 1, yes or no? We started discussing about the other issues in which we listed realized YTM, over or not? Bond immunization, horizon analysis, then forward rates, then the bond refunding decision. Only 2 more points are left. One is what? Convertible bond. Another is bond convexity. With that, the bond chapter stands completed. So now we are going to move into the convertible bonds. Again, a very, very frequently repeated area in the examination is the question from the convertible bond. After a few minutes, I'll tell, okay, please, when I'm discussing, don't worry about AC. Understand one thing. I'm also standing here along with you, right or not? Whatever for you is for me also. In fact, my condition is worse here because I don't have the AC sometimes very much here, as well as no fan for me. Just 5 minutes, Once I complete the introduction, I'll just give you the AC benefit. Can I proceed? Now, when I now start, this is irritating. When I now start, don't say AC off, AC on. And a bus, I am not running a bus, okay. Switch on AC, cinema theatre and only all this demands will happen. So listening to the class, yeah, can I proceed? Now, shh. See, the areas which I am discussing, every area which I discuss are very regularly asked in the exam, whether it is forward rates or the last sum or the convertible bonds. Okay. See, this concept of convertible bond is a very big area in itself, where derivatives like Black-Scholes model, others also can be used. But in our syllabus, with respect to examination, they test only the very basic regarding the convertible bonds. So that is why we are sticking to what is required for the examination regarding the convertible bond discussion. But just to say that what I discussed regarding convertible bond is only 50%. That exists another 50% like convertibles and warranties, where very technical way of valuation and all is going to be involved. Since that is not asked in the exam, nor it is there in the standard textbooks that is written for the CA final, I don't deal with that. If I have time later during the options, if I have time, I'll include 1 or 2 problems of that type and do it. Let's see how much we take time in completing portions. If at all we have, I'll discuss those issues also in the later stages. Still, I cannot discuss that now because it requires some derivatives, understanding. Simple logical way of convertible bond we are going to discuss. Exam question, around 7 to 8 marks question are asked in this convertible bond. All questions are very small and easy to answer, but the main problem is understanding what we are doing. Further, the background introduction about convertible bond is very, very important for us to understand the various questions that are being asked. Okay. See, convertible bonds are those bonds which can be converted into equity shares. I think all should be knowing that or not? Yes, sir. No. Any bond, they pay you coupons and then pay what? Redemption. Instead of getting redemption in cash, one can get the money in what? Shares. Such a bond we call as what? Convertible bond. Understand that conversion is not a compulsion, conversion is an option. No company should compel the conversion. The conversion is what? Option. You can convert or you need not convert. Okay, conversion is an option. Third point, you should know that always we think that a 5-year bond will be converted at the end of what? 5th year. Not at all. So, when a company issues a convertible bond for 5 years, on any day the bondholder has got a right to convert into what? Shares. The option to convert, when to convert, best with what? Shareholders mainly. Now some bonds where company also has got a control above that, I'll be discussing at the end as an appendix. Are you following not? So now understand that first. Convertible bonds are those bonds which can be converted into what? Equity shares. The conversion is a compulsion or option? Option. The bondholder may continue to be what? Bondholder and die as a bondholder. Right or not? The bondholder may become what? Shareholder also. When he wants to become shareholder, he is the option of what? The bondholder only. He can become shareholder on the 3rd day of the issue or also on what? The last day of redemption. It all depends on the will of the bondholder to convert it into shares. These 2 points one should keep in mind while answering the questions. Everybody, can I proceed or not? No. See, convertible bond is a bond or shares. Convertible bond is a bond or shares. We should change that mindset. I am now discussing about a share which is a bond. Are you following what I am saying? Always may say a bond becomes what? Shares. I'll always start my discussion or do my discussion throughout this chapter not by treating convertible bond as a bond. I'm saying what? It is a share which is earlier what? Bond. Are you following what I'm saying? Now, why I discuss that way, we can understand while just going for the elaborate introduction. Can I start with the introduction or not? Now, see. A company is starting a new project. A company is starting a new project. For that new project, it requires money. Right or not? say Tata is going to open a new car plant in some place, means for that he requires what? Money. Money can be sourced internally, or we can go for what? External funding also. External funding, I ask the money from the public. So when I ask the money from public, I can ask the money from public from two sources. Either ask through equity shares or through what? Debt instruments. Right or not? So now the general public has got two options. One is what? Either to invest the money as a share or invest the money as what? A bond. Everybody, are you following what I am saying? Now, let us see what is the advantage and disadvantage of becoming a shareholder or becoming what? Bondholder. Okay. You are an investor. You are an investor. Tell me which is good? Being a bondholder or shareholder? Did you understand my question or not? Now, see, a company wants money. A company wants 3,000 crores money. You can either get the money from you as what? Shares, or get the money from you as what? Bonds. You as a public, as an investor, which is good for you? Shares or bonds? Shares or bonds? Okay. If you become a fund provider as a bondholder, the advantage for you is your cash flows are certain. However the project performs, you are assured of what? Coupon, and then what? Redemption. You have also some secured bonds, means what? You will be having what? Some asset backing also. Bonds are much more safer than what? Share, because the cash flow is certain. Are you following or not? You are given money, with your money only they are doing the business. If you are given money as a bondholder, the advantage for you is you need not worry about the business becoming success or what? Failure, because as a bondholder, you are assured of what? The coupons, even in the years of losses. Are you following or not? But what is the disadvantage? Disadvantage is when there is a prosperity, I cannot share in the prosperity. The project becomes a great hit. Yeah, it becomes what? Great hit. I continue to earn what? Coupon only, and I will not be able to share the prosperity. I will be having heartburn. So much they earning. Give me only 120 rupees coupon means I will be angry or not. So as a bondholder, the disadvantage is I am assured of a certain income, but I am not able to satisfy what? I am not able to satisfy my aim to share in the prosperity. There is no share in prosperity for a debt provider. There is also a certainty in what? Cash flow. The advantage and disadvantage. Yes or no? The ulta is a shareholder. Because if I become a shareholder, I can share in prosperity. That's the greatest advantage of becoming what? Shareholder. But the disadvantage is what? I have an uncertain cash flow because dividend is not guaranteed. Are you following? So, this is a disadvantage and advantage of a share, and then what? Bond. A convertible bond combines advantage of both. Because when I buy a convertible bond, suppose company issues a convertible bond, when I buy a convertible bond, I enter as what? Bondholder, I get a certain coupon, yes or no? Suppose I see the company prospering, I see your company prospering, immediately I can switch over from what? Bondholder to shareholder. Company not prospering, I will die as bondholder. Are you following what I am saying? What I'm saying, in convertible bond, I am purchasing an equity share. I am purchasing what? Equity share. I am purchasing an equity share option where I enter as what? Bondholder. I can become shareholder. I may not become shareholder. I will become shareholder if the company what? Prospers. I will not if the company does not prosper. Is what we call as a convertible bond. Are you all following or not? Tell me. Three instruments are there now. What three instruments? Equity shares, bond, convertible bond. Out of the three, which is having the highest value? Because convertible bond, out of the three securities, what should be trading at the highest price is what? Convertible bond, because it combines advantage of what? A bond as well as what? Equity share. So what happens is, who will issue convertible bond? Any company which is going for a very risky project. Going for what? Very risky project will like to issue what bond? Then only it can attract investors. Because if it goes on a very risky project, when you use the word risky, I don't say loss making. When you use the word what? Risky, it can be a great hit or can be a non-starter. Are you what I'm saying? In that case, when I say it is going to be loss making, even company will not invest. Yes or no? In that case, when I say risky project, it has got great volatility. It can either be a great hit or can be what? Non-starter. When companies raise money for a very uncertain or risky projects, then they can attract investments not by issuing bonds. Because the person giving money says that this project may give me so much money later or not. So why should I invest in what? Bonds for a low coupon, they may think or not. And they cannot attract by issuing what? Share, because they may be afraid of what? Non-starting of the project. So if they issue a convertible bond, they attract more investment. Everybody, point number one. Are you following or not? Similarly, another advantage for the company in issuing convertible bond is, you may say, so what the advantage for the company? Investor is having advantage. He can earn coupon, and if he wants also become what? Shareholder, he can use dividend. What advantage for the company? Question arises, no. Company advantage is a convertible bond coupon will be always lower than a normal bond coupon. Understood? A normal bond carrying 14% coupon means a convertible will always carry what? 12% or 10% coupon only, because they are giving them a share in prosperity later. Are you following what I'm saying? So convertible bond always carries what? Less coupon, because its value is more. Inverse value yield relationship. Are you following what I'm saying? So the convertible bond value is what? More. So the coupon should be what? Less for the convertible bond. So company will be having a lesser cost of capital in the initial years. Are you following not? And the project does not click also, they will continue with what? Lesser cost of capital till what? End, and suffering only less. Are you following not? If the company flourishes, they don't have any problem in giving what? Dividends to the person, because they are flourishing. He has given what? Money. Let the money be what? A share is a fair expectation. Are you following what I am saying? So it is both a win-win situation for company as well as what? The bondholders, when they go for what? Yeah, convertible bond issue. Everybody, are you following what I am saying? This is the first point regarding the convertible bond. More about this we can learn by actually doing the problem. A lot of terms used here. Conversion premium, conversion ratio, downside risk, and so on. All the terms can be understood with this background by actually doing the problems regarding the convertible bond. Everybody have the clarity or not? To summarize, tell me, how many types of securities are there? 3 types. Name the 3 types here. Equity shares, normal bond, convertible bond. Equity share, what advantage? Share in prosperity. What disadvantage? Uncertainty in the cash flows. Bonds, what advantage? Certainty in the cash flow. Disadvantage is what? Cannot share in the prosperity. And finally, convertible bond. What advantage and advantage? Share in prosperity. If it prosper, also gets what? Certain income. This is advantage for the investor. Out of the 3 instruments, which will be trading at the higher value? Convertible bond will be trading at higher value, because it is having a bond as well as option to convert to what? Shares. Can I proceed? Now, point number 2. For company, what the advantage of going for a convertible bond? They are going to have what? Lesser coupons, because I cannot give a 14% coupon for a straight bond, and then what? Because convertible bond person has got a chance of getting a higher dividend or not. In that case, the coupon will be generally less than the normal bonds. So the cost of capital for the company is less. If the company prospers, they have no problems in sharing the profits with them as dividend. If it does not, at least the cost of capital is kept under check by issuing the convertible bonds. Everybody following or not? No. I'll give you the notes for this after doing the problems. 5 problems are there in convertible bond. At least we'll try to complete 2 today and the remaining 2 in the next class. Take the question number. Don't talk. After converting into shares, we cannot convert back into bond, because once you become a shareholder, you assume a risk, right or not? Then you cannot evade your risk and become what? Bondholder. It is not accepted in the market, is understood or not? From a less risky person, you can become what? More risky. You cannot come back, because it is public will be doing all the transaction based on your earlier ones. Okay, then what about all shareholders say, I'll like to become what? Bondholders. Then nobody will be there to take risk of the company, right or not? There should be some bonus or not. So reconversion, not possible. Now, take question number. Don't talk. After this question, I'll give you the elaborate notes. It gives you some idea about the calculations also. Very simple only. In 5 minutes, one can complete this sum. Believe me. Don't get tension that we are nearing the completion time. I will leave you on time. Don't look at the watch. Can I put it up? No. See. Wait. Now, I'm always feeling the tension here, yeah, because whenever I cross 8:45, they're all expecting me to leave. Understand what? Nobody has expectation to continue. Yeah, can I proceed now? Take question number 24, please. Shh. I think in a workbook, question number is what? Same time, same. Okay, question number 24. Please. Shh. Stop talking. Data given below relates to convertible bond. Face value 250, coupon rate 12%, number of shares per bond 20, market price of the share 12, straight value of the bond 235, market price of the convertible bond 265. Calculate stock value of the bond, percentage of downside risk, the conversion premium, conversion parity price. All simple calculation, but should know what it is. That's all. Are you all following or not? No. But with our introduction, everything can be quite easily understood. Can I start or not? Write down first. Before that, tell me, one bond can be converted into how many shares? Can be converted into 20 shares. Got it or not? No. Today I buy the convertible bond. How much should I pay to buy it? 264. 265. I want to buy a normal bond, straight bond. How much should I pay? 235. I want to buy a share. How much should I pay? 240. That is 12 rupees per share. And how many shares there are? 20 shares. Comparably should be there or not? Now, a convertible bond, how many shares here? 20 shares. See, I can buy the 20 shares as 20 shares. How much rupees? 240. Or I can buy the 20 shares as what? Convertible bond. Paying how much rupees? 265. Or I can buy a bond for what? 235. Out of the three instruments which have the highest value, convertible bond, all this. In the paisa no. Because it is both a bond as well as a share. He can become any person based on his convenience. That is why the price is what? Higher for the option given to him. Everybody following what I am saying? So I can start doing the solution. Very simple. Write down first. Step 1. Stock value of bond. Just one liners only calculation. Stock value of bond. This is one of the exam question for 8 marks. After doing it, tell me what 8 marks are not. Okay. First part 1. Stock value of bond. Step 1 above. Step 1, stock value of bond. Stock value of bond is equal to number of shares into stock value of bond is equal to number of shares into MPS. MPS means what? Market price per share. Number of shares into MPS. Market price per share. Which is equal to every bond represents how many shares? 20 shares. This will change or will not change? Will not change. It's an agreed conversion ratio at the time of issue itself. Are you what I am saying? 20 shares. In how much rupees here? 12 rupees. This 12 rupees can change? Yes. Today it is 12. Tomorrow can become what? 10. Day after tomorrow 18 and so on. Into 12 rupees. It is how much rupees? 240. Is equal to rupees 240. Is equal to rupees 240. This is also called as, this 240 rupees, no, it is also called as conversion value. This is also called as conversion value. This is also called as conversion value. This is also called as conversion value. Very simple here. You are holding a convertible bond today. You are holding a convertible bond today. The bond might have been issued 2 or 3 years back. Okay, now we are holding this convertible bond today. Having how many shares underlying it? 20 shares. Today itself, if you want to exercise the option to convert, what value will be getting? 240. This is the stock value of the convertible bond. It's called as conversion value. Everybody, can I was or not? Next. Point, step 2. Step 2. Conversion premium. I'll come to downside risk next. Conversion premium. Conversion premium. Conversion premium. Write down. Conversion premium is equal to conversion premium is equal to convertible bond value minus conversion premium is equal to convertible bond value minus conversion value. Conversion premium is equal to convertible bond value minus conversion value. which is equal to, tell me what is the price or value of the convertible bond? 265. 265 minus, what the conversion value? 240. 265 minus 240 is equal to how much rupees? Is equal to 25. Convertible bond conversion premium is equal to 25. Now listen here. Very simple. I want to buy a share of this company. I want to buy the share of this company. How many ways I can buy the share of this company? Two ways. Either by buying the share directly or buying the share through what? Convertible bond route. Yes or no? In the share market, in the stock exchange, I can see both trading. Okay. One is the company share is trading at 20 rupees and the company's convertible bond is trading at how much? 265 rupees. Respond. Are you following or not? Now I have two options. Straight away buy 20 shares in the stock exchange, in the share market segment, or buy what? A convertible bond which is equivalent of buying what? 20 shares. Ennappa, right or not? Now, if you buy the share, I pay how much rupees? 240. If I buy the bond, I pay how much rupees? 265. Why I pay the 25 rupees extra? Because of the option. You know, are you following what I'm saying? Is the premium paid for giving me the conversion option. Are you following or not? Because when I buy the convertible bond, I have twin advantage. Now, I may be earning what? A certain income. When the company prospers and convert into what? Shares, I am buying a share with a guaranteed income. Are you following what I am saying? In that case, for that I should pay the company a premium or not? Not company, the market a premium or not? The market charge, how much premium for this particular convertible debenture? 25 rupees is the conversion premium. This 25 rupees, why I pay? I pay this 25 rupees because they give me the option to what? Convert. If that is not there, then I have to buy the share only directly. Everybody yes or no? So that is why I say, view this as a share, not as a what? Bond first. You know, right or not? So the conversion premium is what? Convertible bond value minus conversion value gives you 25 rupees premium. Respond. Are you following or not? Now, next. I'll ask a question. You pay 265 rupees and buy the bond. If I want to pay 260 rupees and buy the bond, right or not? Now, my question is, the convertible bond value depends on the share price also. A company which is prospering very much will have its convertible bond more value. Right? What I am saying, in that case, convertible bond value also depends on what? Share price. Now, this 265 rupees, I pay the convertible bond. After 1 or 2 years, suppose what happens is the entire share becomes worthless. Company is what? A loss-making company. The share has become worthless. Extreme situation, the share price becomes zero. What the share price, how much is here? Zero. Tell me, if this share immediately becomes worthless, share price becomes what? Zero. My 265 rupees bond value becomes how much rupees? 235, because even a share becomes worthless, still it is a straight bond. Are you following what I am saying? See, the convertible bond I buy a bond giving me an option to convert how many shares here? 20 shares. That option is attractive as long as the share is performing. If the share is not good, the option is worthless. I don't want to buy a share of Kingfisher, right or not? In that case, in the say, if the share is not performing well, the option is not attractive. So no, suppose the share becomes worthless. For extreme situation, the share price becomes what? Zero. Tell me, the convertible bond value price from 265 will drop to what? 230, because after I purchase next second, they say share is worthless. So what is the bond value? 235, because still it is a straight bond. Are you following what I am saying? That means the downside risk is the maximum fall a convertible bond value can fall is to the straight bond value. Everybody follow what I'm saying? So how much a convertible bond value can fall? 30 rupees. That 30 rupees I call as what? Downside risk. Everybody following? Issue now in that case, so they ask you the percentage. 30 rupees fall from which price? 265. From where I am falling, that should be what? Base. Yes or no? Correct? If you jump from here, there should be the base. If you stand here and jump, that should be what? Base and so on. From where I start falling, there should be what? The denominator. In that case, what the answer here? 30 divided by 265 into 100 gives you the conversion. That is percentage downside risk. Right or not? Right on. Next. Step 2 or step 3? Step 3. Percentage downside risk. Step 3. Percentage downside risk. We'll have the explanations later. Okay, just write down percentage downside risk. Write down. Percentage downside risk is equal to convertible bond value minus straight bond value, convertible bond value minus straight bond value, please divided by what? Convertible bond value. Convertible bond value minus straight bond value divided by convertible bond value into 100, obviously, into 100 is equal to 265 minus 235, 265 minus 235 divided by 265. 265 minus 235 divided by 265 into 100. How much percentage here? How much it is? 11.32%. 11.32%. That means if the share even becomes worthless, the maximum downside fall today expected is how much? 11.32%. Everybody, are you comfortable or not? Now, last part. Part 4. Conversion parity price. Conversion parity price. Conversion parity price is equal to 2, that is, I am buying a bond or share. I am buying how many shares? 20 shares. By buying how much base here? 265. So no, is equal to 265 divided by 265 divided by 20. Conversion parity price is equal to 265 divided by 20. Is equal to how much rupees? 13 point is equal to 13.25. Is equal to 13.25. Understand that I am paying 12 rupees for the share. I am paying what? 1.25 for the conversion premium. Very simple. If the share price becomes more than 13.25, I am said to be making what? Starting to make the profit by buying the convertible debenture. Everybody following or not? This is what we call as a conversion parity price. These are all some basic term which has been discussed. We have few more problems testing in this particular concept. Let's have a brief notes first. Write down notes. Notes. Point number 1. An investor can invest. An investor can invest in 3 types of securities. An investor can invest in 3 types of securities. Branch it into 3. An investor can invest in 3 types of securities. Branch it into 3. First branch, bonds. Second branch, shares. Third branch, convertible bond. Convertible bond. Bond, put it down and write. Advantage is that he gets a certain cash flows. Advantage is that he gets a certain cash flows, but cannot share in the company's prosperity. But cannot share in the company's prosperity. But cannot share in the company's prosperity. Next branch is what? Shares. Advantage is that he can share in company's prosperity. Advantage is that he can share in company's prosperity. He can share in company's prosperity, but cash flows are uncertain. But he can share in company's prosperity, but cash flows are uncertain. Convertible bond, put it down again, right? Can receive certain cash flows. Can receive certain cash flows and convert it into shares if the company prospers. Can receive certain cash flows and can convert it into shares if the company prospers. And can convert it into shares if the company prospers. Everybody following not, right? It combines, same point you write, it combines advantage of share and bond. It combines the advantage of share and bond. It combines advantage of share and bond. Can I proceed? Point number 1 or 2? 2. Out of the 3 securities, the convertible bond will have, out of the 3 securities, the convertible bond will have the highest value. Out of the 3 securities, the convertible bond will have the highest value. The convertible bond will have the highest value. Can I proceed? Point number 2 or 3? 3. There are 3 prices. There are 3 prices. Branch it into 3. First branch, straight bond value. Straight bond value. Second is equity share value. Straight bond value, equity share value. And the third branch is what? Convertible bond value. Straight bond value, equity share value, convertible bond value. Straight bond value, right? How much rupees? Rupees 235. Right, rupees 235. I am explaining the numbers now. For to revise it later easily, 235. What is the equity share value? 20 shares into 12. Don't say 12 rupees because for 1 share, but you are comparing a bond with 20 shares. No, 20 shares into 12 is equal to 240. Third is what? 265. Convertible bond value is 265. Can I proceed or not? Next. Point number 3 or 4? 4. An investor can buy shares in 2 ways. An investor can buy shares in 2 ways. Namely, direct share purchase. An investor can buy shares in 2 ways. Namely, direct share purchase or through what? Convertible bonds. Namely, direct share purchase or through convertible bonds. Or through convertible bonds. Full stop. If he purchases the shares through convertible bonds, he pays how much rupees extra? 25 rupees extra. He pays rupees 25 extra, which is the premium he pays. It is the premium he pays for insuring himself against. It is a premium he pays for insuring himself against uncertain cash flows. It is a premium he pays for insuring himself against uncertain cash flow. For insuring against himself against uncertain cash flow. See, when you pay premium for insurance, you pay premium for life insurance because you don't know about the certainty of the life. It's not always to cover an uncertainty you pay premium. It or not. Now, why he pays 25 rupees premium? Because he buys the share, the dividend is what? Uncertain. And he buys the bond, the coupon is what? Certain. When the dividend flourishes, he convert into what? Say the shares, when he gets a certainty, or you what I'm saying, for that insurance only you pay how much premium? 25. Right? This is called what? Conversion premium. This is called conversion premium. Last point is called conversion premium. Point number 2 or 3 or 4 or 5. Point number 5. Even if the shares attached to convertible bond becomes worthless. even if the shares attached to the convertible bond become worthless. Even if the shares attached to the convertible bond becomes worthless. Attached to a convertible bond becomes worthless. Still, the bond retains the character of a straight bond. Still, the bond retains the character of straight bond and will have what value? Straight bond value. Still, the bond retains the character of straight bond and will have straight bond value. That is, the downside risk in value drop is convertible bond value minus straight bond value. The downside risk in value drop is convertible bond value minus straight bond value. Convertible bond value minus straight bond value. I hope everybody following or not. So, is one of the examination problem regarding the convertible bond. One small sum can complete or not? Okay, I will leave you. So next class we will complete the chapter bond valuation and then start with the dividend policy.
Thank you friends. OMSAI Bhojanapalli.